How to increase profits and limit false entries. Today I show you a simple trick how you can improve any trading strategy by adding a second or multiple time frames. So stick around. How to increase profits and reduce false entry signals. Hello and welcome to another video from Algo Trading Edge. Today we are talking about one of the most important topics of trading, and that is how to increase your profits. So let's get right to it. One proven way of increasing profits is by increasing the odds of having winning trades, of course. Increasing accuracy. And one simple way to increase accuracy of a trading prediction or the odds of having a winning trade is by adding a second time frame or a second symbol. Let's for example look at Apple and how a second symbol can be used. Say you're day trading Apple with a 5-minute chart and you would like to increase your odds of having a winning trade. But to better demonstrate this, let's first use a simple example of a weather forecast, and then we apply the same principle on Apple stocks. Let's say you want to plan a little barbecue party for this weekend and you would like to know the weather. Where do you think you have the higher chance of getting an accurate weather forecast? A, when you get your weather information from a single weather station? Or are your chances higher of an accurate prediction if you listen to a second weather channel that ideally uses a slightly different method to forecast the weather? When you have several forecasts and you take the average of those forecasts, the resulting combined forecast should be better in terms of accuracy. If the National Weather Service says it will be sunny, and the Weather Channel came to the same conclusion and also says it will be sunny, then it's probably a pretty safe bet to go with sunshine. But if the National Weather Service tells you it will be beautiful and sunshine, and the Weather Channel says it will be raining, which one is correct? When it comes to trading and two signals are conflicting, it's usually best to stay out of the market and not take any trades. Does that mean the more time frames, indicators, or signals I use, the better? Theoretically, yes. If you have 10 weather stations and all tell you it will be sunny, that's great, right? Correct. Except in trading, if you have too many signals, there is always conflict. One signal tells you to go long, but at least another one says go short, and therefore you would hardly ever enter a trade. And you would be always waiting until the stars align just perfectly before your strategy tells you to take a trade. We will look into strategy building in future videos and learn how to actually use weighted averages when we have multiple symbols and indicators and how to combine it all in one strategy. So let's look at some examples how you can use a second time frame or second symbol. Let's go back to trading Apple stocks and say you only want to trade with the trend of the overall technology markets. You can simply add a second symbol with a 15 or 30 minute S&P 500 chart. And only if the S&P has a clear strong uptrend that matches the Apple uptrend will you enter a long position. If the two are conflicting, Apple up but tech stocks on a downtrend, you stay out of the market. This alone can already improve your probability of having a winning trade. Or let's say you trade Apple on a 5-minute chart and you're looking for an entry signal using, for example, a moving average crossover or a stochastics or something. In addition, you could add a second time frame of Apple with a 15 or 30 or an hourly chart that also has an indicator, and only if the two indicators clearly give you an entry signal both in the same direction, both long or both short, will you enter a trade. I use the second or multiple time frames in all of my trading. For example, in my crude oil trading I have two different ways that I apply it. Either I use heating oil or natural gas on a second chart. That's another way to use a second chart, by finding a symbol that has a very high correlation to the symbol you're wanting to trade. Or I use a second time frame with a different interval. Let's look at an actual example how I use it to improve my trading profits. What we're looking at here is a 10-minute bar crude oil chart with a range back of 1 year. I turned on my automatic trading strategy, and if I zoom in a bit, you can see how the trading strategy applied all the entries and exit signals. We will go into actual strategy and algorithm building in some other videos, but for this example, I just use an entry signal that is based on a few criteria that then gives me a long or short buy or sell signal when all conditions apply. Let's take a look at how this strategy performed over the last year. And by the way, this strategy has not been optimized at all, so don't be surprised by the low numbers. You see, the total profit was only 2,550 and the profit on short was only $80. That's terrible. Profit factor is 1.11 and the average net profit is really low with only $20, so that's definitely not a profitable strategy as it is. Also a terrible max drawdown of over $6,000. What a terrible equity curve. Minus $5,000 and then slowly getting back up, and it takes 70 trades just to be in the positive. So let's add our second time frame. We're gonna add a second crude oil chart, and we're gonna change the time to 15 minutes. Also 1 year back. Here we say okay. And now let's look at our. We also have to change. I also have to change the data stream in my strategy code. Make this a 2. Okay, compile. Now let's see. We try to reference back to the data stream, so we have to turn the strategy on and off. And now let's see. Now look at that. You see the difference of this performance? Let's look at numbers. Now the total profit went to $12,080. Profit factor 1.76. Still, I think it's the same amount of trades, 114, can't remember. And the total net profit went up to 105. The drawdown is lower. $59 winning trades, 54 losing trades. And here is the trading list of all the trades. And it just looks overall much better. I mean, this still isn't a great strategy, but you can just see the difference. If you add a second data stream, you see the difference that made. See, we only went down to minus $700 versus going down $6,000, and yeah, it went up to 14,000. I mean, it's not a great equity curve, but you can definitely see that it makes a huge difference if you add a second data stream. So now let me show you what works best for my crude oil trading. I usually, instead of a second CL chart, I use a QM chart. So let's change this to QM. And now, look at that. Look at that profit factor, 1.88. The net trade is now at a 131. Drawdown is about the same. And let's look at the equity curve. 95, 47, so we have 50% winners and 50% losers. It looks about the same. It looks about the same in this case, but many times if I use QM, it makes a big difference versus using CL as a second chart. Let's just check quickly to see if it would make a difference if we use a 10-minute chart with QM, so basically 2 10-minute charts. And no, the results are worse. All right, so let's wrap this video up. I think it's already up to 10 minutes. You can see multiple time frames definitely make a big difference. You can get much better trading results, much higher profits. In my experience, you can improve almost every trading strategy by adding multiple time frames and get much better trading results. Please put your questions into the comment sections, or if you would like to share how you use multiple time frames or give us some trading tips how to improve profits, please put it in the comments below.
And if you like to see more educational trading videos, please subscribe to our channel, and thank you for watching.